You scroll past it all the time. Invest $500 a month. Sounds too simple, right? But here's the truth. If you had done this with SCHD over the past decade, you'd be way ahead. Not just in portfolio value, but in growing, reliable income. So here's the question. What happens if you invest $500 every single month into SCHD and do nothing else? No market timing, no fancy strategies. Just steady investing and reinvesting every dividend you get. Now, SCHD has delivered an average return of 12.33% per year since 2011, and it pays dividends that keep growing year after year. If you keep this up for 10 or 20 years, the results might surprise you. But here's the part most people won't like. SCHD could outperform your entire crypto portfolio while you sleep. Yeah, let's talk about that. Chapter 1. What is SCHD? Not just a dividend ETF. Alright, so what exactly is SCHD? It's short for the Schwab US Dividend Equity ETF. Launched in 2011 and built to track the Dow Jones US Dividend 100 Index. But this isn't just any dividend fund. SCHD doesn't chase high yields blindly. Instead, it picks 100 US companies with a solid history of paying and growing dividends. To qualify, each company needs at least 5 years of consistent dividend payments. Plus, their 5-year average payout ratio must stay below 60%. No REITs, no master limited partnerships, only strong, stable businesses. And it's cheap to hold, just 0.06% in annual fees. That means more of your money stays invested. As of July 2025, the share price is $27.06. The SEC yield is 3.78%, and over $70 billion is invested in this fund. Now let's see what happens when you consistently put $500 into it. Chapter 2. Real Stats. What does $500 per month actually do over time? Here's the real question. What if you put $500 into SCHD every month and reinvested every dividend? No skipping, no selling, just slow and steady. To answer that, we'll use actual SCHD data. Its since inception annual return is 12.33%. That includes both share price growth and dividend reinvestment. Let's build the dividend machine from there. Start with year 1. $500 each month equals $6,000 a year. With SCHD's price around $27, you'd buy about 18 shares per month. That's over 215 shares in the first year alone. But here's where it gets interesting. After 5 years, you'll have invested $30,000. If returns stay on track, your portfolio could grow to about $42,700. Annual dividend income? Around $1,600. At 10 years, $60,000 invested turns into $114,000. Estimated yearly dividends? $4,300. Now zoom out. 15 years in, $90,000 invested grows to $270,000, and you're collecting over $10,000 a year in passive income. At 20 years, the numbers get big. You've invested $120,000 total, but your portfolio could be worth around $600,000, and it might generate over $22,000 per year in dividends alone. Now, of course, this assumes consistent market conditions and reinvestment. SCHD's yield might fluctuate, and returns won't be a straight line. But even with ups and downs, the math is clear. The earlier and more consistently you invest, the more your dividend machine compounds. That's the power of steady inputs and growing outputs. Let's now talk about where that growing income comes from. Chapter 3. Dividend Growth Analysis. SCHD's hidden strength. So how does SCHD actually grow your income? It pays dividends every quarter, and those payouts are rising. Let's look at the numbers. In 2020, Total distributions were around 68 cents per share. In 2021, they went up to 75 cents per share, then 85 cents in 2022, 88 cents in 2023, and 99 cents in 2024. Already in 2025, just from Q1 and Q2, SCHD has paid 5 cents. That puts this year on pace to beat the last. So yes, your income doesn't just grow from buying more shares. It also grows because each share is paying more over time. That's also the share split to consider. In October 2024, SCHD did a 3-for-1 split. If you owned 100 shares, you now own 300. The share price dropped to around $27, making it easier to buy more monthly. This doesn't just change your portfolio value, but it helps you feel the progress. More shares, more income, more momentum. And when dividends grow consistently like this, the compounding gets stronger. That's what turns a basic ETF into a true income machine. Chapter 4. Where your dividends come from. Now, let's pop the hood. Where does your dividend income actually come from? SCHD holds about 103 companies, but here's what matters. The top 10 stocks make up over 40% of the fund. Big names like Texas Instruments, Chevron, PepsiCo, Cisco, and Amgen. These are companies with consistent earnings. They've been paying and increasing dividends for years. And SCHD doesn't just pick random high-yield stocks. It screens them carefully. Each must have a non-negative 5-year dividend growth and a payout ratio below 60%. That means your income is backed by companies with strong balance sheets, ones that don't overspend or overpromise. Now, let's talk sectors. The top 3 are energy, 19.4%, consumer staples, 18.8%, and healthcare, 15.6%. These industries tend to stay strong even during downturns. Also, no single company can be more than 10% of the portfolio, no sector more than 25%. That helps reduce risk from any one stock or industry crashing. So your $500 buys you a slice of diversified strength. Dividend payments backed by profit, not just hope. That's how SCHD delivers stability and consistent income year after year. Chapter 5. Hidden Risks and Taxes. Now let's talk about the parts people skip. The hidden risks and the tax side. First, volatility. SCHD may feel safe, but it's still made of stocks. Its max drawdown was 13.89%, and its 3-year standard deviation is 16.01%. That means your portfolio will swing up and down. Still, SCHD historically falls less than the market. It only captured 88% of the downside compared to the Russell 1000 Value Index. So yes, it's more stable, but not immune. Next, taxes. For US residents, most SCHD dividends are qualified. That's good. It means lower tax rates, 0%, 15%, or 20%, depending on your income. But even if you reinvest, you still owe tax in the year the dividend is paid. Now here's where it gets tricky. For non-US investors, the US normally withholds 30% of your dividends. Some treaties lower this to 15%, or even 0% for retirement accounts. But wait, there's more. In 2025, the US proposed a new law, Section 899, also called the revenge tax. If passed, some countries could lose those tax treaty benefits. The result? A withholding rate of up to 50% on US funds, and it would apply even if you already have a treaty. Also, non-residents face estate taxes on US assets above $60,000. That's up to 40% if not properly planned. Bottom line, SCHD is powerful, but only if you understand the tax angles. For non-US residents, this could be a deal breaker. Chapter 6. Key mistakes to avoid with SCHD investing. Let's go over some common mistakes people make with SCHD. First, expecting monthly income. SCHD pays quarterly, not monthly. If you need regular cash flow, that timing matters. Second, reinvesting dividends. This is a big one. Without reinvestment, you lose the compounding effect. The dividend machine slows down. Third, ignoring tax drag. Even if you don't see the dividends because they're reinvested, they're still taxed. Plan for that. Fourth, comparing it to growth ETFs. SCHD isn't built to skyrocket, it's built to compound steadily, with income you can rely on. Fifth, selling during market dips. Yes, it'll go down sometimes, but those dips are when your reinvested dividends buy more shares. So don't panic, stay consistent. Avoid these 5 traps, and SCHD can work exactly how it's designed to, as a long-term income-building engine. Chapter 7. Conclusion. The $500 per month dividend machine blueprint. Let's wrap it up. If you invest $500 a month into SCHD, reinvest every dividend, and stay consistent for years, not months, you can build a real income machine. With a 12.33% historical return and a growing payout stream, SCHD combines growth and income in one clean package. It's not flashy, it's not fast, but it's reliable. For US investors, it's one of the most tax-efficient, low-cost ways to build dividend income. For non-US investors, check your local tax treaty carefully, because if structured right, $500 a month into SCHD might just change your future. And that brings our video to an end. Thanks for watching till the end. Make sure to subscribe to our channel for more updates and share this video with your friends.